Dun Bradstreet's 5 credit scores and ratings showcase a company's strengths or weaknesses to vendors, suppliers, and lenders. A full D&B report contains 5 unique types of business credit scores and ratings. D&B also offers 3 types of predictive scores which predict how a business will perform over the next 12 months. There are 2 types of performance scores D&B based on a company's past performance. Predictive scores predict a company's expected performance over the next year or 12-month time period. D&B provides 3 predictive scores: the D&B Delinquency Predictor Score, the Financial Stress Score, the Supplier Evaluation Risk Rating. The D&B Delinquency Predictor Score predicts whether a business will pay its bills on time. The Financial Stress Score predicts the chance that a business will experience financial distress. The Supplier Evaluation Risk Rating predicts whether a business will stop delivering its goods and services. D&B's performance scores reflect a company's past performance using only information within the D&B database. D&B provides 2 core performance scores: the Paydex score and the D&B Rating. The D&B Rating indicates a company's net worth range based on company financial statements as well as a company's overall condition. The Paydex score indicates how a company has paid its bills over the last 24 months. 3 Dun Bradstreet Predictive Credit Scores. The D&B Delinquency Predictor Score predicts whether a business will pay its bills on time. It actually predicts the likelihood that a business will make a severely delinquent payment. D&B defines severely delinquent as 91 days or more past terms. So basically, someone is severely delinquent when they pay more than 90 days late. The true definition from D&B is: Delinquency Predictor Score predicts the likelihood a business will pay severely delinquency within the next 12 months. The D&B Predictor Score ranges from 101 to 670. The higher the score, the lower the risk. The D&B Delinquency Predictor Score is further broken down into 5 classes. Class 1 reflects a low risk of late payment. Class 5 reflects a high risk of late payment. The D&B Predictor Score is influenced by D&B's data regarding past payment performance, demographic information, financial information, outstanding lawsuits and liens. The D&B Predictor Score is used by suppliers, customers, and banks. The score is used to make decisions about your company. For example, lower risk delinquency predictor scores means you have a better chance of securing credit with suppliers. Suppliers, customers, and banks can not only pull this score, but monitor it ongoing. And they can even receive alerts of changes, such as when the score moves between risk classes. So a supplier would be alerted if the score changes, and then could pull back extended credit even if the late payments were with others, not that specific supplier. Suppliers, banks, and customers would make this decision to pull back credit due to increased and changed risk from the initial application. Dun Bradstreet's Financial Stress Predictor Score. D&B's Financial Stress Score predicts whether a business will experience financial distress or failure. The true D&B definition is: the Financial Stress Score is used to predict the likelihood that a company will obtain legal relief from creditors or cease operations without paying all creditors in full over the next 12 months. The score ranges from 1001 to 1875. The higher the score, the lower the risk. The D&B Financial Stress Score is broken into 5 different classes. Class 1 reflects a low risk of late payment, while Class 5 reflects a high risk of late payment. This score is influenced by details D&B has regarding your past payment history, demographic information, financial information, outstanding lawsuits and liens. Potential business partners, banks, other lending institutions, and customers use the D&B Financial Stress Score to determine if you will have the financial resources to handle your expenses. For example, a company hires a consulting business for a 10-month project. A high financial stress score could be used by the consulting business as justification to extend terms to the company instead of requiring upfront payment. Dun Bradstreet's Supplier Evaluation Risk Rating. Dun Bradstreet's Supplier Evaluation Risk Rating is known as the SIR rating. The SIR rating also predicts the likelihood that a supplier will cease business operations or become inactive over the next 12 months. It predicts whether your company will deliver goods and services as promised. It predicts the likelihood that a business will stop delivering their goods and services. Scores range from 1 to 9. The higher the score, the higher the risk. Your SIR ratings is influenced by D&B data including past payment performance, demographics, financial information, outstanding lawsuits and liens. Vendors, suppliers, and other business partners use the SIR rating to reduce the cost and risk of choosing suppliers and to gain competitive advantage. For example, let's say a company is choosing a building supplier and needs to deliver their product quickly. While considering many suppliers, the company chooses the one with the best SIR rating, as they believe that company can deliver quickly and on short notice. 2. Dun & Bradstreet Performance Credit Scores. Dun & Bradstreet's D&B Rating. The D&B rating indicates a company's net worth range based on company financial statements as well as a company's overall financial condition. If a company's financial statements are not provided, the score is based on company size, industry, or other related factors. The D&B rating is a performance score that's based on a company's net worth and overall credit assessment. The D&B rating is broken into 3 distinct categories. Category is assigned based on the amount of information available on a company. The true definition from D&B is D&B rating is a performance score based on a company's net worth from its financial statements as well as an overall credit assessment using information in D&B's database. Category 1 is the traditional D&B rating. Category 2 is the expanded credit appraisal. Category 3 is the alternative ratings. Category 1 is the traditional D&B rating, which reflects net worth or equity. D&B calculates this based on the company's financial statements and payment experiences or trade lines. Both must be in the report to qualify for the traditional D&B rating. Even if you have payment experiences, if no financials are present, there will be no traditional D&B rating. This score also includes the Composite Credit Appraisal Score. The Composite Credit Appraisal Score reflects an overall assessment of creditworthiness based on company payments and financial stability. If financials are not available for a company, the company falls into the Expanded Credit Appraisal category. This is based on the total number of employees for the business. If financials nor company size is available, D&B gives a score in the 3rd category, known as the Alternative Ratings category. This is based on the amount of information available in the company's report. Dun & Bradstreet's Paydex Credit Score. Dun & Bradstreet's Paydex Credit Score is the most popular and well-known business credit score. It indicates how quickly a company has paid its bills. The true definition from D&B is D&B Paydex is a dollar-weighted indicator of a business's payment performance based on payment experiences in a company's D&B file. Another important aspect of the Paydex system of which most business owners are not aware is a Paydex weighted average score. This score gives more weight to the trade accounts that report higher amounts of credit extended and less weight to trade accounts that are reporting lower dollar amounts of credit. The Paydex score is weighted, meaning the bigger the bill, the more weight it can have on the D&B score. This score gives more weight to the trade accounts that report higher amounts of credit extended and less weight to trade accounts that are reporting lower dollar amounts of credit. The Paydex score ranges from 1 to 100. Higher scores are lower risk as they predict better payment performance. Any score of 70 and higher, D&B defines as a good score. An 80 score reflects prompt payment. A score of 70 reflects payments are paid within 15 days of terms. Scores 50 or lower represent payments being made 30 or more days past terms. Business credit scores are based only on whether the business pays its bills on time. A 100 score means to expect payment may come early. 90 means payments comes within early discount period. 80 means payment is prompt. 70 means payment comes 14 days beyond terms. 60 means payment comes 21 days beyond terms. 50 means payment comes 30 days beyond terms. 40 means payment comes 60 days beyond terms. 30 means payment comes 90 days beyond terms. 20 means payment comes 120 days beyond terms. UN means unavailable. Higher scores get new business owners better payment terms, lower insurance premiums, higher credit limits. Due to these benefits, higher scores make it easier for a business to manage cash flow. Be aware that banks do pull the Paydex before lending, even though they won't send you any disclosures letting you know they did pull your score, as they don't have to. Having no Paydex score or limited credit will commonly lead to loan denial. For example, if a lender pulls an incomplete report, they typically will decline the application. But if a lender pulls a high Paydex score, the chances of being approved for credit lines from suppliers and lenders greatly increases. Suppliers and lenders can also receive updates of score changes.